First rates, it's a truncated week, and the first rates are 21 points lower for the Nifty. The breadth is in favor of advancing stocks versus declining stock. The Bank Nifty up 45 points. Now let's look at Kotak Mahindra Bank. Yes. Reaction? Well, markets are saying one uncertainty on succession planning is over. Another one, which in terms of delivery will start. Stock is cheap, so the fall is not a very meaningful one. So 29-30 rupees lower for Kotak Mahindra Bank, which frankly nobody is going to be even talking about it. That's like just a result reaction. ICICI Bank and Paytm, two other stocks which are worth revisiting in terms of where the market is. And ICICI Bank up by 1% and Paytm down by 3 rupees. And Loris, which I think came during market hour on Friday, the con call must have got over, and now markets would be digesting those numbers. 396 rupees for Loris Labs.
There's RBL Bank as well, where the NIMs have improved to 4.9%. The gross net NP ratio is now at a 16-quarter low. A nice move of about 1% and counting higher for RBL Bank as we speak. L&T Finance also came out with its numbers. The Q2 numbers are above estimates, NIM at an all-time high. That stock is well holding out marginally in the green as we speak. There's also JSW Energy. The margins have come in, expanded quite a fair bit at almost touching 58%. 4% is the gap up move that you're seeing on this newly listed entity. Revenues as well higher by 36.5%. There's Balkrishna Industries also, wherein there's been a fair amount of margin expansion to 23.6%. That stock though starts off a little bit tempered, 1% lower as we speak right now. Paytm, Nikunj was just flagging off that stock. Let's check in on what that stock as well is up to right now in trade. Decent numbers, but no, the stock is lower by about almost 1.5%, or rather 1% as we speak. IDBI Bank as well, the asset quality has seen an improvement, so that's another stock which should be starting off in the green. Yeah, surely it is, up over 2.5% as we speak. There's also Poonawalla FinCorp, blowout set of numbers there, NIMS expansions, AUM uptick of about 54%. There's also Central Bank, wherein the asset quality has shown a sequential improvement. That stock also higher, marginally albeit. Credit Access Grameen, NIMS at 13%, AUM uptick of 36%. There's J&K Bank, a significant asset quality improvement on a sequential basis. NII uptick of nearly about 11%. J&K Bank holding up 2.5% as we speak right now. So lots of earnings and a lot of positive news flow. But amidst that, of course, there's Oberoi Realty as well, wherein the Q2 booking value has come in down by about 20%, and the units booked as well in this quarter, while they of course showed an uptick on a year-on-year basis. Yes Bank below estimate numbers. Finolex Industries, again a disappointment there. Amber Enterprises reported a loss. EBITDA is down 62%. There's Goa Carbon, again weak numbers there. Suntech Realty and EBITDA loss versus profit. Sasken Technologies, EBITDA down 52%. So it's a bit of a seesaw out there, as is for the Nifty, which is absolutely flat. But Kunal, the first trades that you're punching in.
Yeah, so I think Tata Motors could be something which looks interesting. The stock is at 660, 670 zone. It's been a breakout point for Tata Motors, so that's something which I'll look to trade at the open.
All right, that's Tata Motors punching in the first trade from Kunal. What about you, Naresh? What's looking good?
So continue like CRISIL as a short-term defensive bet. The stock could go towards 4,600, 4,700 levels. So buy at current levels, add more on dips.
Okay. Let me now welcome Jayakumar Jakes, Managing Director Prime, to just take our conversation forward. Jakes, happy Navratri, happy Dashera. You're changing colors. Never seen you in an Indian attire. Only time I used to see you in an Indian attire was Diwali. Now Diwali and now hopefully Dashera and Diwali both.
Well, I guess it's the time of the season when you get invited to important channels in the market. So you need to be, when you go to war, you have to be dressed for war, as they say. But this is not war time, other than in certain parts of the world. But thank you for having me over, and wish you and your investors and viewers the very best.
Jakes, it's been a good year. It's really been a good year, given that what is happening in the world, how interest rates have been volatile, how tricky it's been to call global flows in the global picture. I guess Indian markets have done well for themselves. So why is that?
I think the underpinnings of the market have everything to do with a set of investors a certain set of events which we don't talk about enough, which is the retail investor. For too long in my working career since 1985, that's now 38 years, we've only heard, little jibes and jabs about investors creating, the tops when euphoria is, rife and people sort of jump in. We've heard of them selling out when panic is on the screen and stuff like that. The reality is that the investors, the retail investors in India, courtesy, I think principally the SIPs that have grown almost 10x over the last 6-7 years, now aggregating almost 16,000 crores a month, which is about $2 billion, and that annualizes about $25 billion. So you're talking about some serious money. And we've always looked at what we call the poster children of the market, which is the FII inflow. And maybe that's something that needs to change and change quite dramatically, which is that the FIs have actually been sellers. And against that headwind, we've had retail investors, not a single retail investor whom we can name in a sense, but folios have increased, demat accounts have increased, and their SIPs, the allocation to Indian markets has increased. And that's been, to my mind, what's been buttressing this very steady rise, nothing euphoric, but a very steady rise in the Indian markets.
Yeah, absolutely. Jake's hi, morning. You put it rightly, and I guess that is what's showing India's resilience at a time when you've got so much wobbliness across the globe. But tell me, in your notes, you've talked about how the Ds have it, and they've never had it better. Highlight for our viewers what makes India's bullish construct intact, according to you.
I think for starters, we've had, I think the entire, the policy-making initiatives, which, at the margin have been probably aimed towards regions initially, then towards countries. And now whether by default or otherwise, which is another D, we probably are, at the helm of everyone's attention. And any policy making of any kind in the world, geopolitical, can't ignore, I would say, the Indian reality. That's number one. Demographics have always been there. So this entire population that's been seeking, jobs to consumption, to everything else, the startup economy, it's all been driven by that 20 to 40 age group. And that's the second D which is there. Demand's always been there. Demand, especially in the context of an extremely uncertain global environment and aging populations in most parts of the world. Whether you take Europe or you take now, interestingly, China. And China now is actually paying pretty dearly for its one-child or two-child policy that they've had for a while. And these policies have actually meant that the working population and the younger age group have actually been depleted quite a bit. And the aging population is just not making consumption and any stimulus-driven consumption happen. And an economy that's been principally driven on exports, and in an environment where global economy is weak and the local demand is weak, China has been actually coming a distant number two in several comparisons as far as India is concerned. And I think, as I said, this particular confluence of various events is really what's created this, dramatic move towards the Indian Ds, whether demographic or demand or any of or digital, for instance, the entire growth that's been led by technology. And technology, at the end of the day, is one aspect which makes for a finite input and potentially an asymmetric output. And that's the kind of a change which the digital shift in India has created. That with finite interventions in various parts, whether it's direct benefit transfers, whether it's the smallest thing in terms of Aadhaar, etc., the digital economy, the purchasing, virtually everything is now turned digital. So I think there are very few things that I can look back and say that we haven't done, whether by default or by design, which haven't turned out great from a confluencing perspective at this point in time. And that, along with this retail SIPs, is creating this huge global oasis where people are desperately looking for avenues to invest in. And especially over the last couple of years where people, most parts of the world have lost money on equities, have lost money on bonds, have not made money on precious metals. And really, therefore, people have lost out on most asset categories. And in that context, India has stood out like a beacon. And I think that's where it is. And, without meaning to even talk too much about it or jinxing this, but this is really the construct around which I think the next 8 to 10 years for sure will or should pan out.
But you think, Jake's interest rates remaining elevated, crude largely around, 85, 90 or could that challenge us in the near term in any way?
If the global economy is going to be as weak as it is, I don't think crude really goes above this 9,500 levels. I, for one, am not in the camp that believes that crude will move up, especially in the context of, interest rates potentially remaining elevated for at least some length of time. I'm not too sure if crude will also play ball along with it. I think the bigger structural issues are around the American balance sheet, where nearly $30 to $32 trillion of debt are being supported on an average at about 3 to 3.5% of borrowing costs, which is $1 trillion of interest liability every year. And in that context, and with the paradox that most people in the world are still borrowing in dollars, you have this amazing paradox where there's demand for dollars from a borrowing perspective or from being used as the currency of the currency standard, and you have the US debt at this levels. So there is, it's very clear the US can't print its way out. And I believe, therefore, that as interest rates move higher and higher, or have moved higher rather, and perhaps are very close to peaking out, and maybe another 0.5% more is my take on it. So I think in the 5.5% range, we should be peaking out. Interestingly, if you go back in history, every time interest rates have been this high, people have moved towards real assets, which means everything from capex to capital goods to reconstruction. So is it conceivable that the next 20 years in the US, you have a demand led by an infrastructure boom where everything from airports to bridges to pipelines, etc., not just privatized but reconstructed? I think there's a real possibility that Europe will follow suit, and that's the way the US will move. And this may well be the model that as interest rates remain much higher than they have been in the last couple of decades, you will have an infrastructure boom, you will have a capex-related boom as the world moves towards real assets compared to what it's done in the last 2 or 3 decades. So I think that itself is another export-led advantage for India, where India is the manufacturing capital. If we were to sort of arrogate ourselves to that position, could well be hugely benefited as manufacturing exports could take off in a massive way over the next couple of decades.
Jakes, why do you like pharma? I mean, this is one sector where it's been difficult to call the earnings trajectory. Sometimes it is US FDA, sometimes it is pricing power, sometimes it is both. Post-COVID, the sector got re-rated, then massively got de-rated. Is it looking prime for a comeback?
Well, I think for one, the under-ownership has never been higher. Number two, people have viewed this sector as a trading bet rather than as a structural bet. Number three, it's also true that the common man, especially in most parts of the world, like especially in the US, is hurting. And therefore, insurance companies and the move in general towards cheaper generics rather than patented drugs, that move has never been stronger. The voices have never been more strident. And I think that move will ensure that the Indian generic space. So in pharma, we can't take a broad sweep. I would look at the generic space, and I would look at key areas like the PLI, which is an incentive which the government has given for domestic manufacturing, especially of critical inputs. So companies that are either in the generics dominated or have got exposures in the PLI and domestic pharma in general has been growing, but growing quite steadily, nothing spectacular. A combination of these two, valuations are on their side, balance sheets are relatively unleveraged, and most importantly, ownership is very low. If you take all this into account, I think pharma could be a very interesting space, which will, I think, continue to get money much more than the trading kind of box that we.
And what's making media so appealing?
So if you compare media with FMCG, which is a comparison I've drawn up more to justify my arguments, I suspect, but it's still under-owned. Media exposure for most funds is very, very low, number one. the media sector, like the FMCG sector, is consumer-facing. It's as competitive. And unlike the FMCG space, it's actually dominated by 2 or 3 groups only, which account for pretty much most of the listed and media exposure in the country. So a combination of that, balance sheets are relatively healthy. In fact, some of the media balance sheets are very positive in terms of cash richness, if you will. And the most important thing is valuations here are 1/3 to 1/4 what FMCG peers command at a time when we justify FMCG by saying most of it is habit formation, that we buy the same toothpaste, we eat the similar food, similar brands, and challenger brands are also given valuations that are reasonably compelling. Yet in media, that's not the case. And if you really look at it, media watching is about as habitual and as habit forming as you can get. So the comparison with FMCG is very high, competitiveness is high, the granularity of pricing power, etc. is high, and yet valuations are 1/3 to 1/4, and ownership levels have never been lower.
Okay. Good to have you on board. Thanks as always for joining in and giving us more clarity as to where your preference lies and views on the markets. 19,536 is where we're at. We'll take a very short break, but we've got lots of corporate voices lined up. The management of Credit Access Grameen when we return.
Back with first trades right here, Nifty. Now let's just revisit what the first trades are settling in at and where we're currently at. For the Nifty, of course, we continue being quiet right now in trade. Haven't seen much of a move since where we started off in trade, but lots of movers. ICICI Bank sitting right on top with a 1% gain. There's Bajaj Finance holding out very well. There's Divi's, M&M, DRL ahead of its numbers later this week. They're all looking very smart. Even the broader end of the market actually. So Ipca Labs, it's a 6% move no less on this particular stock. There's MCX, Emphasis, GNFC and Delta Corp. Quite interestingly, this is one stock which has been seeing some, dead cat bounces all through last week. And today, too, the momentum is actually continuing. It's holding up 3% as we speak right now. But Credit Access Grameen, let's throw focus on this one. We've got with us the MD joining in on the show right now, Uday Kumar Hebbar joining in on the show with us. Uday, great to have you today on Nifty Now. Thank you so much for taking the time out. Just going through your quarterly performance and your gross loan portfolio has grown 36%, but you haven't upped your guidance for FY24. It's still at about 24 to 25%. Why is that?
I think, it's why it is 36% with a lower base. So I think, on a higher base, we believe that our growth should be a little moderate than last year. The annual growth of last year was 27%. So therefore, we thought, and then our based on our own internal feedback and the stage at which we are here, we thought it would be prudent to grow little, moderately at about 24-25%. So we have not changed the growth guidelines, but we have changed some other key parameters in financials, like ROA, ROE, cost to income, as well as the NIM guidance. All these guides have been made upward after the Q2 results.
Okay. So the cost of capital now is going to remain benign. Most of the NBFCs, they borrow from the wholesale market. Given that the yields are going to settle in and around 7% and the wholesale cost will come down, what will happen to your cost of borrowing, cost of liability going forward?
One of our strengths is to have a right liability mix, So we try to have a very good diversification, including, international borrowing. Probably we are one of the largest international borrower now, almost 20% of our borrowing international. And the domestic banks are, benign in terms of pricing. If you look at last 1 year, our cost of borrowing has gone up only by 60 basis. So even with such 60 basis, we can always, pass on to customers if there's a high reason to change. But we have not changed our pricing for last 9 months. So and we don't have any plan to change our price to our customer for next 3 months also. So cost of borrowing is at about 9.6, 9.8%. And this is quite good price for us, actually. And I think it is getting into a zone where it will be stable going forwards. and with the other ability of raising, the public debt. So we raised public NCD last month about 1,000 crores at 9.3%, 9.4% average price. I think we should be able to manage the cost of borrowing well, and our liability franchise as a strong liability we are able to build in terms of diversification, long-term positive ALM, all those things we are able to manage.
Trajectory can we expect for your NIMs, because you managed to expand on account of the improvement one has seen in yields despite rising cost of funds. What's the range that you're working with for your NIMs now?
So we guided about 12 to 12.2, but I think we upgraded in this after Q2 by almost 60 bips. It is 12.7, 12.8% NIM, which is a stable status we should be able to give, which is quite good, which can result into almost 5.5% of ROE and close to 24-25% of ROE.
To also understand the outlook on some of the other growth guidance that you have revised, apart from your net interest margins, you've revised the FY24 loan growth guidance as well to 24 to 25% from the earlier 20%. What exactly is driving this growth, and why? What makes you positive?
Not really. Actually, we actually not changed the growth guidance. We stayed with the 24-25%. So, but there may be a small movement in terms of microfinance loan growth may be a little lower than 25, whereas non-microfinance, which we piloted last year, started scaling it. I think those will replace those kind of growth. Overall, still the overall growth what we guided earlier also now also the same 24-25%. I think we should be able to achieve that. We're quite on track in achieving that numbers what we guided.
No, what I meant was it was revised from 20% to 24%, which is what I was talking about. But that aside, let's also talk about the outlook in terms of, the elections. Are you looking at any sort of an impact, any impact on the systemic disruption from the potential loan waivers? Are you equipped to take care if so these challenges arise?
Not really. Normally, we have not seen an impact on microfinance, whether it is for us or for the industry. There may be a small, growth. I can't say growth disruption. It's a muted growth during the election time, as we all of us have to, follow the code of conduct as we are under the rural land working in the cash-based economy. So therefore, for a month there may be a small, muted growth. But for that, we never saw any negative impact because of elections also. So I think we really don't see any impact because of elections or any other disruptions, at least for the near future for this business, either for us or for the industry.
Look at some of your peers. State elections play a large role there, and there are cases where state elections, when the verdict changes, it leads to recovery, it leads to issues in terms of NPA cycle. Is that a risk for your balance sheet, because 3 state elections are due now, big states?
No, not really. See, elections are a common factor in our business. When you're a large all India player, one or other state, there will be elections always. There may be a very small impact in the rule. Depends on in a village or a taluka or a district. But in the overall perspective, it is very small. And if you look at the last 10 to 12 years of history, there are so many elections happened. Maybe because of election industries, NPA never grown beyond 1% or so. So therefore, I don't see a reason to worry because there's election. I think so long we are in the right business and supporting the rural economy, even the politicians or the government recognizes that there have been continuous support despite 2 years of COVID, which could be the fertile ground for somebody create a problem, but really didn't happen. Across the country, there is a huge support from the politicians or the government or the administration always. So which is a key factor for the growth of microfinance in the last 2-3 years.
Your outlook on your asset quality, that has improved, but your provisions have risen sequentially. Where is it that you see your asset quality on the incremental book? What does that look like? Any downside risk then when it comes to the the commentary or the caution that was sounded on unsecured credit?
No, actually, what we guided the credit cost about 1.6 to 1.8%, which includes the, if you see our provisioning norm is slightly different than the peers or the industry. We provide, we treat 60 days plus as an NPA, and then 15 days plus as a stage 2. Therefore, inherently we provide more. Therefore, credit cost increases as we grow also. The growth itself will add the credit cost to some extent. So early recognizing and providing is one of the key strengths of Grameen. Therefore, though there is not too much variation in the cost, but the growth also adds the provision, therefore, which goes into credit cost. If you look at today, our GNPA is 0.77%, which is a 60 days DPD. So, and if you see 90 days, it's only 0.6, but our provisioning is at 1.6%, which is quite higher compared to the type of NPA. Therefore, credit costs includes these additional provisions also.
Okay, thank you for taking us through your growth targets as well as outlook on business. Good to have you on board. Thanks so much for joining in. So that's the view coming in. Credit growth guidance 1.6 to 1.8%. They have also revised their net interest margin trajectory as well as their loan growth. The stock is on fire in trade today. Tell you what, we'll slip into a very quick break right here on the show. The management of L&T Finance joins in with their earnings fine print when we're back. Thanks for staying on with us. As promised, the management of L&T Finance here with us. Let's talk a little bit more about their quarterly performance, given the fact that they did declare a pretty strong set of numbers in terms of profits as well as net interest margins. Dinanath Dubhashi is the Managing Director and CEO now joining in. Thanks so much, Mr. Dubhashi, for taking time out. Now, given that your Lakshya 2026 goal outlines retail growth at a 25% plus CAGR, in the first quarters, your growth has already surpassed 30%. Would you like to revisit your targets?
Good. Thank you for having me on your channel. It is not only the growth target which has been surpassed. All the 4 Lakshya targets. The first one is the retailization. Our target was 80% of retailization by 2026, and you would see that we are already at 88%, and we are still halfway to 2026. Growth, as you rightly said, is 25% CAGR was our target, and we have last year we did about 33%, and we are more than 30% in this first half. Gross stage 3 and net stage 3. Net stage 3, our target is less than 1%. And retail net stage 3, and we are at 0.67%. And the retail ROA, our target is 2.8 to 3%, and we are already at 3.4% around thereabouts, 3.32%. So yes, all the targets have been achieved, and it's not about setting a new target. What is it, or what is going to be the endeavor of the company and all plans of the company is how to sustain growth. Whether it is going to be 30% or 25% for the next 4 or 5 years is not that important. But what is important is this kind of growth, even 25% CAGR, how is it sustained year on year despite whatever happens in the economy, at the same time reducing credit cost and improving asset quality. And all the plans we are making are on that aspect. So I wouldn't like to answer in the short term what will be the growth rates. I can only say that good, healthy growth rates will continue. We have good plans for that. And at the same time, credit cost will continue to improve, and that will obviously work on profitability and ROAs positive.
Which segments do you think would largely drive the growth ahead? Could you highlight the disbursement trends seen on ground and your expectations for the festive season?
So as you see, our quarter 2, normally speaking, for any lending company, quarter 2 is the worst quarter of the year. This quarter 2 has actually been our best ever disbursement quarter, best ever retail disbursement quarter at around 13,000 odd crores. Now, why? How has this happened? Right? It has not just happened by depending on market growth. It has happened by doing many things. One, yes, expanding our customer funnel, acquisition of new customers. But at the same time, making sure that this database that we have, close to 2.2 crore customers, is farmed well. And that has led to close to 38% of the disbursements coming from existing customers. Now, this is crucial. This is crucial because new customer acquisitions will always go up and down. Life is seasonal, business is seasonal. But when you have the customer with you, it is in your customer database, we being able to farm that database. And there are some companies which do much better also, but we have been increasing it quarter on quarter, and today it is at 38%. That, when done well, actually reduces acquisition cost, reduces credit cost, because these are your tested customers. And that has been our strategy, which has led to a very, very good disbursement in Q2. Now, as you rightly said, Q3, all this will work, and as well as festive season. So we are quite confident that Q3 will be another fantastic quarter for us as far as disbursements is concerned. Which product? I believe, frankly, that it will be across products, both rural as well as urban.
All right, and the rundown of your wholesale book was accelerated. You had planned to achieve a 90% realization. Does it seem likely that this would come through in Q3? And by when do you expect to be done with the complete rundown of the wholesale book?
I would say that, as I said, against an 80% target, we are already at 88%. And I can today say that definitely by the end of the year, we will be between 90 and 95%, surely. Beyond that, what remains, by the way, it is all of good quality. What remains, we will not be in a tremendous hurry to sell it, because any tremendous hurry to sell anything just sees that the buyer will unnecessarily ask for discounts, etc. We don't see any need to do it. What is important is it is today at a level where it is not a drag on the overall profitability. So you will see now, there was a gap between our retail ROA and total ROA because of the wholesale. Now this gap is reducing drastically. Our retail ROA is 3.3 and overall ROA is already 2.42. And slowly as we go ahead, this gap will reduce. And I would think that in a year or two, the overall ROAs will also go beyond 3%. So that's the strategy, and it's working beautifully.
Expanded by 45 bips, higher than what the street was anticipating. What is driving this sharp improvement?
It has been contributed by two things. Cost of funds has been fairly steady, right? Sequentially, it has gone up by just 2 basis points. We have a big advantage of a large book, rural book, a part of which is eligible for PSL lending, and which allows us to raise funds at good cost from banks. So that is one of the reasons why funding cost is remaining well in control. Number one. Number two, very simple. Our product mix is changing. So as product mix changes more and more towards retail from wholesale, naturally the weighted average NIMs are going up. Even within retail, the rural and the rural business finance are high NIMs businesses. So this is what has driven this NIMs plus fees. Also, good fee income has driven this NIMs plus fees. I had indicated last time that we are entering a longish period, 12 to 18 months period of steady interest cost. It doesn't look like that anymore. It looks like the marginal cost of funds in second half will be maybe 25 to 30 basis points more than in first half. But with the the product mix changes that we are having, we should be able to keep the NIMs at very good levels. Whether they will be 12.12 or higher, I don't think I can say. But yes, we have been always guiding our NIMs plus fees around 11.7%. I think we should remain comfortably above that.
Now, while your NII is up about 12% on a year-on-year basis, your net profit has grown. For the interest of our viewers, can you just highlight what has exactly led to this strong growth?
You would see that the profit after tax is up by close to 46% smartly to 595 crores for the quarter, which is very clearly a bumper profit. Now, what this has been contributed by is very strong NIMs plus fees to record levels, and also continuous reduction in credit cost. Now, what contributes to the NIM plus fees? First of all, very close control on cost of funds, which sequentially has gone up by just 2 basis points. And secondly, very strong yields, which mainly is contributed by positive movement of the portfolio mix from towards retail towards rural. So that is continuing, as you know, it continues to move towards retail and rural as we go ahead. Credit cost on the three axes of better underwriting, zero DPD culture and management, and better collection of whatever flows through a strong collection team, we are confident of credit costs continuously reducing from quarter to quarter. And that gives us, that is actually the reason for a strong profit growth, and that gives us the confidence that such kind of strong PAT will continue as we go ahead towards the end of the year.
Merger between L&T Finance and L&T Infra Credit Limited and L&T Mutual Fund Trustee Limited has received a nod from NCLT. By when do you expect the merger to go through?
Okay. See this, I will answer the second question first. There is no cross-selling because LTFH was only a CIC, it was only a holding company, right? I will tell you the reason why this holding company existed. It is because we had a mutual fund. And the NBFC, operating NBFC, could not hold a mutual fund. That is why the listed entity was a holding company. After selling the mutual fund, there is no reason for continuing with this complicated structure. So the whole reason is actually simplifying structure. Simplifying structure, so we will be only one lending company once the merger is complete. Synergies come out of management bandwidth. It comes out of, just number of board meetings to be conducted, number of boards, etc. Just people required for consolidation of results, number of external auditors, all those things will come up. In terms of expenses, synergies will come. Second synergy will come in terms of asset liability management. Today, we need to manage asset liability buckets on all the three companies, which leads to much higher level of cash or liquidity lying on the balance sheet. This can be better managed, and hence some interest cost can be saved. These are the synergies. But most importantly, simplicity and transparency is what we are looking from this. The only step remaining now is the final SEBI approval coming after NCLT. Once that is approved by SEBI, and I can't give a date for a regulator to approve, once that is approved, it will be done pretty fast.
Okay, thank you for joining in and giving us that view on how the outlook is when it comes to your overall financial metrics. 138, that's where L&T Finance Holdings is currently trading at. Just a quick check-in on the rest of the market. We're at about 19,500. It's pretty quiet and lackluster when it comes to the broader universe. And within the mid and small caps, names like BSC, Credit Access, where we spoke to the management, IPCA Labs, Kaveri Seeds, and ICICI Securities, those are some of the stocks that are flying about up and away in trade. Vikas Goyal is now joining in. He's the managing director at PNB Gilts, here to talk a little bit about their muted set of numbers. Thanks so much for taking time out. Just help us understand the numbers this time around. Your profits have fallen quite sharply. What is the reason for this? Can you explain the cost side?
Yes, of course. Thank you for having me on the program. Last quarter obviously was a major departure from quarter one. Couple of reasons. As you are aware, we deal in fixed income markets. We are a primary dealer in fixed income markets. Therefore, our primary risk is interest rate risk. So last quarter, our commitment to the market, we increased our commitment to the market for two reasons. One was inflation was expected to trend down, and obviously there was talk of index inclusion in the air. Now, what really prevailed, to put it rather simply, was that on the index inclusion side, that view came out correct, but it was a classic buy on rumor, sell on fact. And post the inclusion news, yields actually went up rather than coming down. So that was unexpected, which obviously affected us adversely because we had enlarged our commitment to the market. Second thing was that market, rather than looking at Indian numbers, where inflation has been trending down, and that number is now obviously out, published September numbers, which was at that time expected, has come out to be more or less lower than where Reserve Bank and market expectation was. So that also was correct, but the market started focusing on a soft landing probability of US market increasing, which was reflected in their bond markets, where the inversion, the 10-2 inversion actually reduced. So the curve started flattening, and 10-year yields, US Treasury yields started going up, and now obviously they have hit about 5%, as you are aware. So that affected our markets also adversely, where yields also started mimicking what was happening in the US market. And that was basically the net result. I mean, our commitment was high, and while the views turned out correct, but the market behavior was opposite of what we had expected.
3-4 months from now, the entire action in the primary market will reach to a different level as India will get ready for the bond inclusion, the global bond inclusion of JP Morgan. How will that change life for PNB Gills? I mean, the liquidity will change, the entire impact cost will change. What changes for you because of that?
Okay, so let me answer that in two parts. One is the immediate next 2 quarters, and then the next year, because what we're referring to will start happening next year now. So in the next 2 quarters of this year, I think you have already seen the MPC minutes. Indian rates or monetary policy will continue to remain restrictive. Liquidity will continue to remain restrictive in the foreseeable future. That is one. And obviously, there is this geopolitical risk, which is new, which will impart volatility to oil prices, as a result, potential volatility to inflation outcomes in India. So the next 2 quarters, as far as we are concerned, we will be very conservative in our approach to market. Therefore, the results will not be as volatile as they have been in the past. We expect very muted outcomes because our commitment to the market will be muted. Having said that, now coming to the next year is looking, as of now, obviously there is a lot of uncertainty around views right now, as you are aware, globally as well as in India. But 2-3 things are there, which is a silver lining. So one is the index inclusion. So flows will start $2.5 billion a month from June onwards. Obviously, that demand will lead to hopefully yields coming down and prices going up, which is obviously good news for us. So we may participate indirectly in this outcome via our participation in the market, and directly we may have potentially some clients who come to us to fulfill their investment requirements by buying from us directly. That is one. And the second part is that hopefully next year at some point of time, this restrictive monetary policy will change course and accommodation will start getting reinstated. In other words, rates will hopefully start coming down in terms of repo rate being cut, so on and so forth. Expectation as of now of market, which was originally when the market started out, there was a thinking that Q3 of FY24 is when RBI will start obviously reducing rates. Currently, it's anywhere between Q1 of FY25 to Q2 of FY25. So we have these two positives coming to us next year. So hopefully next year will be a reasonably good year for fixed income market participants.
So if interest rates peak out where they are, when I say interest rates peak out, bond yields they peak out where they are, could you see an HTM gain also in coming quarters? Because if the cycle pauses or reverses, automatically gains will start coming back?
Yeah. So That is true. We are a mark-to-market player, as you pointed out rightly. So obviously rates have peaked out. If rates start coming down, obviously it is good news for us. So if that happens this year itself, that will be good news. Having said that, like I said, our commitment to the market is now very conservative. So we want to preserve capital. The idea is to focus more on the opportunities available next year. As of now, we see limited opportunities this year. However, opportunities look slightly better and far more next year, as I said.
Well, great to have you on the show, and thanks for highlighting in depth as to how the quarter gone by has been and what lies ahead for PNB Gilts.
Thank you very much.
Okay, let's move on and let's talk about what else is happening in the market, and let's take it across to Vamakshi, find out what brokerages are saying about BSE now. Vamakshi?
Well, yes, BSE in focus. The company earlier announced that they will be revising their transaction charges earlier than anticipated in the equity options segment. Now, largely we have two brokerage notes coming in on the same, and there is a massive upgrade that has actually come through from Investec. They've gone ahead and upgraded their rating on BSE from hold to buy, and there's a massive upside that they see in the stock because they've gone ahead and hiked their target price on this counter from 540 rupees per share to over 2,140 rupees per share. Largely, they have highlighted that nearly 4 times hike in the transaction charges increases the earnings visibility for BSE. Not just that, also the Sensex option volumes have been rising at a remarkable pace, which actually in turn is a very positive indicator for BSE. So all in all, given those factors, Investec has actually gone ahead and increased its FY24 and FY25 revenue estimates by 5% and 30% respectively, and has gone ahead and increased the net profit expectations by almost 11% and 67% respectively for FY24 and 25. Apart from that, IIFL has also gone ahead and upgraded its rating on the counter from add to buy and hiked the target price from 1,600 rupees per share earlier to 2,000 rupees per share, and they also believe that this could be a positive indicator for BSE. They believe that the BankX especially could be in the next growth driver, and they've in fact upgraded their FY25 and 26 EPS estimates by around 25 to 35%. They believe that momentum in BankX as well as further tariff increases could drive the earnings surprise as far as BSE is concerned. So all in all, brokerages are indicating the increase in the transaction charges in the equity option segment as a positive for this counter, and that is the reason why the stock is soaring in trade as of now.
Vamakshi, we'll leave it at that. Just want to bring up the Nifty chart for you because I think we've breached that 19,500 print while we were holding out absolutely flat up until now. Now you're seeing a sudden dip down come in for the index. What's adding pressure? There's, of course, Tata Steel, which is down. There's Adani Ports. There's LTIM. Kotak Bank, by the way, even after that mildly positive start, that stock has completely reversed trend. Bring out the intraday graph for this one, about 1.25% lower as we speak right now. There's L&T, ITC, TCS. The only good thing is that the cuts within the Nifty are not as deep so far, which is why we're managing to hold out okay. Of course, there's ICICI Bank, M&M, Bajaj Finance, which also movers, and they're holding up well in trade. But let me take it across to Kunal. Kunal, before I come to your chart buster, just a quick word on the Nifty and what this breach of 19,500 once again would mean in an expiry week.
Well, it would of course dampen the sentiments in terms of the expiry because it's going to have a significant impact in terms of the rollovers for the next series. But the good part which I'm observing over the last 3 days for the indices is that the rollovers have already started to happen in the previous week itself for both the Nifty as well as Bank Nifty, and so far the short rollovers are slightly less as compared to the the rollovers in the previous expiry. So that generally is an indication that maybe we not be going through a incremental or a large kind of a correction on the indices, and 90,300 has been a major support. So I think till the time we float about those levels, we can probably try and expect the momentum to stabilize a bit more.
19,300 continues to be a support. Now let's talk about chart busters. Kunal, you've picked out Hero MotoCorp.
Yeah, it's an interesting chart. So we were discussing many of these auto names earlier, that how many of these auto stocks are starting to show signs of recovery as well as a breakout. Hero MotoCorp is also a stock which is in the potential candidate of a breakout. Now from 2018 highs, the stock which is almost at 4,000 levels over here fell down to as much as 1,500 in the COVID correction. and then the stock restricted and came back towards 3,500 mark. So if you look at this previous major highs for Hero MotoCorp from 4,000 to 3,500, and now the stock which is closer to this 3,200 odd mark, this is an indication that the stock is trying to retest its trendline resistance on the longer term basis. On the short term as well as on the medium term charts, the stock has been making a pattern of higher lows. So the earlier base of 1500 converted to 2000 as a support, now 2200 as a base for Hero MotoCorp, which means that the stock is going through a contraction over here. The moment the stock breaks out of this 3200, 3250 mark and sustains above this level on monthly closing basis, we would expect the stock to get back into the line of outperformance. So this also indicates that the auto sector rally may not be a short-lived rally, but there could be many of the other larger cap names which could start to participate. Hopefully, Hero MotoCorp could be the stock which can participate over here.
Okay, watch out for that stock in trade. By the way, the frontline index as well has come under a bit of pressure right now, but just sub the 19,500 mark is the point that I'm making. Naresh, let's get in your take as well as to what's looking good.
So that would be a chart for CDSL. The stock has been making a dash around that 1400, 1410 mark for the last almost 1.5 months. A classical cup and handle formation. It topped out around 1400 odd levels back in September of last year, corrected all the way to 900, made a recovery to 1400, dipped back to 1300, and now back to testing that 1400 mark. Today, the stock came closer to 1400, did a dip back. At current levels, a good risk reward, large volumes today compared to the last 4-5 sessions. Stock could eventually break out going forward. So a good risk reward here, stop loss at 1340, target of 1700 to 2000.
Okay, let's find out the top stock recommendations as well and stock ideas that our chartists are picking out. Kunal?
I'll go with a defensive name. HUL is the first stock which I would suggest as a buy. The stock looking attractive on the intraday chart, so targets of 2570, stop loss at 2470. And L&T Finance is also one of the stock which is perched closer to a breakout of 140. So expecting a breakout pretty soon for the stock, targets of 145, stop loss at 135.
Okay, there you have it. Those are some top recommendations from Kunal. And what's looking good according to you, Naresh?
So being defensive against a buy on Power Grid, which has been holding on, a stop loss at 202, target price of 220. Second is a buy on CRISIL, which has broken out, stop loss at 4100, target price of 4700.
Okay, on that note, we'll take a very quick break with news that it's getting a little unsettling for the markets. We are sub the 19,500 mark. Let's see where we settle down. But when we come back, full tilt on festivities and we'll celebrate the Shera the 18-hour way.